Right now, the US economy is sending mixed signals that are confusing millions of Americans. On one side, stock markets are touching record highs, big companies are reporting strong profits, and headlines talk about growth. But on the other side, something far more important is happening quietly beneath the surface. Americans are losing confidence in the economy at a speed we haven't seen in more than a decade. And when confidence breaks, history shows that real economic trouble usually follows. In today's video on the US Report, we are going to talk about what is really happening inside the US economy right now, why people are worried, why markets are still going up, and what all of this could mean for your job, your savings, and your future. This is not just another update. This is a story that affects every household in America. Before we go deeper, make sure you hit the like button and subscribe to the US Report. We break down complex economic stories in simple language, so you can understand what is happening without the noise. Your support helps this channel grow and keeps you informed as these stories continue to develop. Now let's talk about the biggest headline that most people are not paying enough attention to. Consumer confidence in the United States has just fallen to its lowest level since 2014. That means Americans today feel worse about the economy than they did during many difficult periods over the last decade. The latest data from the Conference Board shows that the Consumer Confidence Index dropped sharply in January 2026, falling to around 84. This is not a small move. It is a major warning signal. Consumer confidence measures how people feel about their income, their jobs, and business conditions in the near future. When this number falls, it usually means people are preparing for harder times. What's even more concerning is the expectations part of this report. This part measures how people feel about the next 6 months. Will jobs be available? Will incomes rise? Will businesses do well? That expectations index has now dropped well below the level that economists often associate with recession risk. And it has stayed there for more than a year. This tells us that Americans are not just worried for a few weeks. They have been worried for a long time, and that stress is building. So why are people feeling this way? Let's break it down in simple terms. First, prices are still high. Even though inflation is lower than it was at its peak, everyday costs like groceries, rent, insurance, and utilities are still putting pressure on household budgets. Many people feel their paychecks are not stretching as far as they used to. Second, job growth is slowing. While unemployment is not exploding, hiring has clearly cooled down. Recent months have shown weaker job creation compared to previous years, and people are starting to feel less secure about their work situation. Another major factor is uncertainty. Trade tensions, tariff discussions, political pressure, and global conflicts all create fear about the future. Businesses hesitate to invest, employers hesitate to hire, and workers hesitate to spend. When uncertainty rises, confidence falls. And when confidence falls, consumer spending usually follows. This is important because consumer spending makes up roughly 2/3 of the entire US economy. If people slow down their spending, even slightly, it can have a big impact. We are already seeing early signs of this. Spending on big items like cars, home renovations, and expensive electronics is starting to weaken. At the same time, spending on basic necessities and discount stores remains strong. This tells us many families are focusing on survival, not lifestyle upgrades. Now here is where the story gets confusing for many viewers. If people are worried and spending less, why are stock markets still going up? Why are headlines talking about record highs on Wall Street? The answer lies in who the stock market actually represents. The stock market is driven largely by big corporations, investors, and expectations about future profits. Right now, large technology companies and AI-related businesses are attracting massive investment. These companies are still making money, and investors believe they will continue to grow in the long run. This has created a clear divide between Wall Street and Main Street. Wealthier households that own stocks and assets are benefiting from market gains. Meanwhile, middle and lower income households are feeling squeezed by prices, job uncertainty, and slower wage growth. This type of divide has appeared before in US history, and it often leads to social and economic tension. Another key piece of this puzzle is the US dollar. Recently, the dollar has weakened against other major currencies. A weaker dollar can help exporters and multinational companies, but it also makes imports more expensive. That means higher costs for many goods Americans buy every day. This adds another layer of pressure on households already dealing with tight budgets. And then there's the Federal Reserve. The Fed is currently in a very difficult position. Inflation is lower than before, but it is still not fully under control. At the same time, economic momentum is slowing and consumer confidence is falling. Cutting interest rates too early could reignite inflation. Keeping rates high for too long could slow the economy even more. Markets are watching every word from the Fed, hoping for signals about future rate cuts. But for now, uncertainty remains. When you combine all these factors, a clear picture begins to form. The US economy is not collapsing, but it is not as strong as headline numbers suggest. It is uneven. Some sectors are doing very well, while others are struggling. Some people feel optimistic, while many feel anxious. This kind of environment is fragile. Small shocks can have big effects. Looking ahead, economists are divided. Some believe the economy can avoid a recession if inflation continues to cool and confidence slowly recovers. Others warn that prolonged low confidence could eventually lead to reduced spending, layoffs, and a sharper slowdown later this year. What happens next will depend heavily on consumer behavior, job trends, and policy decisions. This is why staying informed matters more than ever. Understanding these signals early can help people make smarter decisions about spending, saving, and career planning. At the U.S. Report, our goal is not to scare you, but to prepare you with clear and honest information. As we move forward into the rest of 2026, we will be watching key indicators closely. Consumer confidence, job numbers, inflation data, Federal Reserve decisions, and global developments will all play a role in shaping the next chapter of the U.S. economy. The coming months could define the financial future for millions of Americans. Now I want to hear from you. How do you feel about the economy right now? Are you feeling confident, stressed, or somewhere in between? Are prices affecting your daily life? Do you feel secure in your job? Leave a comment below and share your experience. Your perspective helps others understand what's really happening beyond the numbers. If you found this video helpful, share it with someone who needs a clear picture of the U.S. economy right now. And don't forget to like, subscribe, and turn on notifications so you never miss an update from the U.S. Report. Thanks for watching, and we'll see you in the next video.